Welcome everyone to our latest webinar in our Capital Insights series. Apologies, there were some technical issues on the back end, wouldn't you know it? But we're here and we're ready to go. So thank you so much for joining us today. This series here is meant to provide information and have a discussion on topics related to funding your innovation startup. And today's session is focusing on funding basics for life science companies. I'm Petra Stegman, VP of Educational Programs at Connect. Connect is a nonprofit organization created some 30 years ago, and since then we continue to work with life science and high-tech entrepreneurs to help them grow and scale their companies through the various programs we offer. We have a stellar program lined up today, so let's get started. It now gives me great pleasure to introduce today's moderator, Deepa Rich. Deepa is a partner in Goodwin's Life Science Group and Business Law Department leader for the Silicon Valley office. She has years of experience working on corporate transactions for high-growth biotech, med device, diagnostic, healthcare, and digital health companies. She also represents venture capital funds and underwriters in the life science industry. Deepa co-led the development of Goodwin's Women's Health and Wellness Initiative, a cross-functional effort guiding the innovators and investors reimagining the women's health and wellness sector. She received her JD degree from Santa Clara University School of Law. Welcome, Deepa.
Thank you so much. Apologies for everyone. I'm not on camera. I am the technical difficulty portion in the background, but I'd like to welcome you all to the session. We have two great panelists, Kim Kamdar and Remo Mumiai, and I'd love to get them on screen and provide a little bit of background about themselves, and then we can get the session started. So Kim, I'll turn it over to you and then to Remo.
Sure. Thanks, everyone, for the opportunity to join you all today. My name is Kim Kamdar, and I'm a scientist by training, PhD in cell biology, biochemistry. I have been on the venture side for 20-some years now, first as a managing partner at Domain Associates, which is one of the oldest healthcare-focused venture funds, and now under a new mantle, Medical Excellence Capital, which is really sort of an extension, if you will, of the Domain Associates brand. Medical Excellence focuses on early stage companies. We often take on acting operating roles to help get companies off the ground. And I've had a great pleasure to be one of the founders and sometimes founding CEO of companies, a number of companies in the San Diego biotech ecosystem, including Syndax, which is now a publicly traded oncology company, Aspen Neuroscience, which is in the Parkinson's space, cell therapy for Parkinson's disease, as well as some companies on the tools instrument side like Truvian here, again, locally in San Diego. Thanks.
Hello, everyone. My name is Remo Mumiai. I'm the CEO and co-founder of Cytonus Therapeutics in Carlsbad, California. By way of background, I'm actually a physician. I spent 9 years as an academic surgeon at Yale. Co-founded a company also in San Diego, which has been rebranded into Zergo Health as an entrepreneur. I've also, for a period of 4 years, been an active angel investor out of the Midwest. And most recently, in 2020, co-founded Cytonus Therapeutics, which is a UCSD spinout. Happy to be here.
All right, thank you both very much. So Kim, so we'll start with you on this one. As a first question is, given your experience at Domain and now at Medical Excellence Capital, how many companies do you look at to reach a single investment decision? And what are the key considerations about a company that you look to when you're making your initial investment decision at the early stage?
Yeah, the math here is not great when it comes to how many we look at versus those that we invest in. I mean, typically I would say on an annual basis, we look at about 1,000 deals. And by this, I mean really sort of how many actually we get introduced to or come in, if you will, through the transom. it's a lot of companies to be kind of continuing to sort of analyze, but we'd have a quick filter and decide actually on, a smaller number to focus on. And of those, I would say that we typically would invest in somewhere between 4 to 5 in any calendar year. So again, the math is not great, but I would say that the ones that actually get higher attention from us are ones where the intro is actually coming from somebody that we know versus over the transom. So, if Deepa or Remo actually says, "Hey, Kim, this is one that I know the entrepreneur or founder, or I know the CEO, and I actually would think this is one that fits well," because of the relationship side, that's one that we would look at a little bit more closely. And in general, I would say, and this is a little bit motherhood and apple pie, the things that we look for are, for domain or medical excellence, it's always been about trying to find new approaches that are going to really make a difference in healthcare, right? So our investment thesis is always going to be on, is there good intellectual property that either has already been sort of carved out? What's the science? Do we actually feel like there is a really good sort of take on how to actually approach this from a healthcare standpoint, and does it make sense? But the big factor goes back to what I was saying. This is very much a relationship business, and it's all about the people. So what we're really looking for is, are the people that are involved, either at the founder level, the entrepreneurs that are involved, the advisors, are these people that we actually want to spend the next 7 to 10 years with, because that's how long it actually takes to get a company all the way from start to finish, sometimes longer. And we want to know that it's people that we really enjoy being with, people that we think we can actually build a great company with.
No, got it. Thank you. And so, Rima, I want to pivot to you here because, Kim kind of touched on introduction. So how do you as a founder, and how do founders typically, can they get introductions to VCs? So a lot, once you get there, it's still, as she said, the numbers aren't great, but with all these different factors, you can get filtered through. But how do you get that initial meeting and that look?
Yeah, it's a good question. I mean, there's no one approach, I think, that works for everyone, but fundraising in general is essentially a contact sport. And, you just have to do it. You have to shake a lot of hands. You have to meet a lot of people. It's always really good to have advocates that do give you warm introductions to other VCs to essentially extend your pool. But I think I'd have to echo what Kim was saying, that it always comes down to a relationship. If you look at, or if I just look at my own experiences with raising funds for different companies, the investors that we seem to have a real sympathetic mindset to and are aligned with from the beginning always are the most valuable players in the investment pool. So everyone understands there's going to be a lot of highs and a lot of lows. And really what you should be thinking about from an entrepreneurial side is, assuming there are a lot of lows, who is going to be there to help you to figure out a solution? Investors are just a very small part of them are their actual checks that they write. A far more valuable component is what they bring to the management side as far as help.
So is that more like, Rima, like alignment with your vision? And they would be, if they're on board member, they're bringing in you're looking for certain skill sets. Is there's specific phenotypes you look for at an early stage company as opposed to when you're, BC and beyond?
Yeah, absolutely. I think from a phenotype, I personally like a diversity of thought. So I try to mix it up with people who have real area expertise to be, investors. But it's certainly, I don't think it's a bad thing necessarily to have other investors who are obviously within the sector, but not necessarily experts with what you're doing, whether it's some specialty cell therapy or ASO type of technology. So it's always really nice to have a bit of balance there.
No, makes sense. And so the next,
But one thing if you don't mind me interrupting also, Deepa, I think one thing that I feel as you're especially getting later in the discussions with a VC and they're starting to move to, interest level and saying that they're going to actually put a term sheet in, I think it's also perfectly appropriate for the entrepreneur to actually do diligence on the lead investor, the partner that's going to be joining you on your journey. And by that, I mean, ask them actually for, the contacts of other CEOs that they worked with, so you can understand actually what their, sort of thought processes, how they really are, because for every company, it's not really going to be sort of like sort of from start to finish one straight line. Like there's going to be, as Rima was saying, ups and downs. And what you really want to understand is, is this somebody when things are not going well, is this the kind of person that's joining your board that you can actually call at any time and they're going to actually pick up the phone and they're going to be there for you to help you navigate those lows? Or are they going to actually, as soon as you call to tell them something's wrong, they're going to panic and then become yet another problem for you to have to deal with, right? Well, and or they decide that, okay, this investment, because of some issues, is no longer actually really one that's going to drive their portfolio, and they're just no longer actually even kind of available and making their, certain, not very helpful, in which case that too is something that would be good for you to understand. So it's really important to, I would say, even do that diligence and call other CEOs and understand actually kind of who you're getting in bed with, frankly.
Yeah, I couldn't agree with you more, Kim. I would say, the term sheet is kind of like the final contract, but it's really that often 4, 5, 6 months of working with that individual to really understand a little bit more about who they are as a person, how you might align with them from a personality perspective. And also, it's very important, and this is critically something I would always recommend everyone to do, is talk to your peers, right? Because it's a relatively small world, and a lot of people know a lot of these venture capitalists, some at a very personal level, and that they often give you a lot of insight that you're not getting in the courtship stages of getting to know a new VC.
No, I think those are great points. And, and it's great to hear that, Kim, also that VCs are open to having that discussion and saying, hey, can we talk to other CEOs that you may have worked with, and also reaching out to peers. And I think, Remo, you hit a big point, which is the term sheet stage is just the beginning. And you can tell a lot about the relationship when you're negotiating the term sheet as well, in the back and forth. And so, kind of want to throw this question to both of you as, let's talk about the term sheet itself, one from the relationship aspect, but the other are, key terms, this tug of war between terms, between potentially founders and early stage VCs. And, what should you look for and what should you practically avoid? What should you not get caught up in?
Yeah, so I mean, I'm happy to start, but then Rema can actually sort of hold me in check, because this is the VC entrepreneur sort of check and balance, right? Now, I will say, actually, I think the thing you shouldn't focus on too much on is valuation, right? It's an important feature, obviously, but it's not really what you should focus on. Or let me say, there's at least sort of several other, I think, really important aspects to the term sheet that really sort of define other components, including things like what's the option pool, what's the liquidation preference, and also very importantly, the composition of the board. I say, because I think that, as an early stage investor, one of the aspects on the board side is that you want to make sure that you have, a small but very efficient, highly functional board. It comes through some of the things that Remo said about making sure that you're looking for diversity of thought, people that are actually going to have a network that's really going to be helpful. But you also, want to know whether your director seat, say as the CEO, is it defined as CEO or CEO founder? Because you could actually then lose your board seat someday if you're essentially ousted from the executive position as the CEO. So that's sort of already getting into kind of control provisions. And the other one I'll just touch on before I hear from Remo, and love to hear his thoughts on some of this, but liquidation preferences is another one that I think, especially early on, best approach is to sort of, ensure that you're getting something that's fairly plain vanilla, like a 1x liquidation preference, right? I mean, obviously these are provisions that are kind of attached to preferred stock, and they're meant to sort of help a VC protect their investment, like, especially when the startup is only going to end up with sort of a downstream with a mild to moderate sort of exit, as opposed to the big grand slam that we're all hoping for. And basically this is the order in which you end up actually, and how much of that payout occurs. But if you already start with some liquidation stack that's a 2x and then some other sort of features on it, the problem is that in your next rounds of financing, that's only going to get added to. And if you're not careful, actually, the biggest problem is that you've already created a scenario where just, you're either going to have such a high exit for common to even participate, that it becomes, really problematic. So those are very important features. And I would say the best advice on any of this stuff is to make sure that you have a good lawyer on your side. And I say that because Deepa is actually our moderator, and I don't want her to cut me off.
Well, thank you for the plug, Kim.
And Kim, you really don't need me here. You're like answering all these questions. Fantastic. I was going to also add, first of all, it is really important to get a good attorney and groups of attorneys around your startup. And a lot of the things, even prior to getting a term sheet, I think you could really button up and do it very nicely, with the idea that you're not going to walk into essentially some sort of trap later on, even after you take monies from your first set of investors, which is what I think Kim was referring to. That being said, I couldn't, I couldn't agree with Kim more with regards to some of the hangups that I think people have regarding valuation. Understand that, reasonable people become great partners, and that goes both ways. So I certainly have come into circumstances where I think I'm at times getting a little heavy-handed toward, people are treating us a little bit differently, just because you are an early stage company, and you have to really question whether you want that, right? Is that the type of relationship that's going to get you and your company to the next level? From a starter's perspective, I personally feel like we're in this for the long run. And so there are things that investors want with regards to preferences for liquidation and so forth that I don't really get hung up on personally. I think that, again, the term sheet has to be looked in its totality. And as much optionality that you can negotiate out of a term sheet, the better it is for your company.
No, these are great points. One of the things, and I wanted to, Kim, you and Remo both touched upon this, and there's a jump ball question, but control provisions, right? So we talked about, liq pref, et cetera, but voting thresholds, right? So a lot of founders that, we work with we're going to have to cede some control when that initial capital comes in. What are some of the control provisions that are kind of easy enough to give up, from, on a common stock basis? And what are the expectations, just to kind of set the framework for this is, the first VC investment in, and what are VCs going to expect, and how open-minded should founders be? Because some control is being ceded. So if you can talk both a little bit more about those control provisions, I think that'd be helpful.
Sure. And, what's interesting is that I've seen over time, actually, these control provisions become more standardized. There's even actually on the MVCA sort of list now, a lot of provisions that are sort of, in their template their template for a term sheet become actually sort of standardized. And some are actually at the level of the board, and some are actually at the level of the shareholders. And obviously, I think some, are ones where you can imagine, like from a venture capitalist point of view, they are in the job of actually trying to make money for their limited partners. So they're not doing this, ultimately for some, sort of because they have like sort of a control issue and want to actually be the ones that are making all the decisions. It's really because at the end of the day, they need to be able to, they've put money into the company now, they're answering to their limited partners, and they need to have some provisions in to make sure that they're not, that there's not like another round of fundraising that's done without their sort of approval, because it will impact actually the, the level of, of their ownership, things of that nature. And so there's some provisions that I think come part and parcel with having a VC investment. But I'd encourage actually for folks to go to the NVCA website. There is actually what I've said now is sort of almost a template that is part of it. And I think, as much as possible, actually best to sort of have that level of control at the board side, and you understand who's actually on the board. And very rarely have I been, in the sort of 20 some years that I've been in venture, seen it where it comes down to an actual vote on the board. Meaning that for the most part, like Rayma was saying, these are actually discussions about how to do what's right for the company going forward. And I think, you have to understand what the mindset that the VC has, and it's really about protecting the capital that they're actually deploying, and making sure that they have the ability to be able to at least achieve some kind of a return on that capital.
Yeah. When it comes to board and control, the advice I would have to add would be that, and I've seen this happen occasionally. A lot of times people put individuals on boards, or they ask them to join boards, and there's no real reason. Like there's none that I can see, at least at face value. And sometimes it's maybe an early stage mistake to do this just because you believe someone can add some connectivity, and often it's someone who's somewhat of a celebrity of some variety that doesn't really have any necessarily good governance background when it comes to what a board should be doing. So I don't necessarily think that that's a good thing, and often it leads to some real issues that I would avoid. Yeah, that's all I would add to what Kim was saying.
All right, so I think we touched on the control points. The next is kind of pivoting back to valuations. So, Kim, how would you, how do you go about establishing valuation for an early stage company from a VC standpoint? And then, Remo, from your standpoint, from the founder standpoint, I know Kim's founded lots of companies as well, but from your shoes, like, how do you work with investors to reach a valuation that's acceptable, knowing that you both said don't get too hung up on the valuation question and look for the highest valuation term sheet? That's not what you're looking for. But how do you settle on what it is at this early stage of investment and development?
And I do think this is actually where most entrepreneurs sort of early on kind of focused, because they think actually ultimately that's like, this is what the value is, the overall company is, and that can be actually where folks get hung up. I remember actually once hosting a fireside chat between John Stupnagel and Jay Flatley, who obviously like founder and then sort of future CEO of Illumina, and the one comment that they made jointly was that throughout time, the one thing that they were actually sort of encourage people to do is not focus on the dilution, right? Continue to actually grow the company, build value, but it really starts with, okay, so what is the valuation? And it is really more of an art than a science, I would say, in terms of determining what the valuation is going to be. So it's not like there's some complicated sort of formula that a VC is using, but it is important to kind of understand the math exercise just in broad strokes. And there's a couple of things that investors would be looking at. They're in the first case, actually just saying, okay, what's the post money going to be after the financing? And then in addition, how much additional capital is going to be necessary in order to get to some liquidity event? Because what they're ultimately looking at is, okay, what's the return potential after all of that? So if you continue to sort of imagine that the company assumes success, the company's continuing to grow, what sort of return potential is there? And I would say an early seed or Series A, what they're really looking for is a 10x return. So they want to still make sure that in general, the valuation range that they're talking about allows them to actually get to some, sort of 10x. And why a 10x? Because there's, and there's been a ton of math on this. When you look at overall portfolio for a VC, there's really only one or two investments that actually make the fund, meaning they're going to return that high of an amount of capital. The vast majority will, be a 1 or 2x, and you have some that don't return capital. And so you're sort of overall trying to actually, you go into every investment trying to determine that this is going to be one that has the potential to be that 10x return. I would say later stage investors are looking at something that's, because it's less risk and a shorter time frame to exit, they're generally looking for a 2 to 5x kind of return, more 2 to 3x, I would say. And so that math exercise is kind of what's going on in their heads. And I think the other sort of way that a VC will arrive at a valuation is they'll look at what the current post money is, and then look at current market conditions, and they'll either sort of say, okay, let's add a step up based on where the market is, maybe 10, 20%, or in these financing times, frankly, it's more like a 20 to 50% down round, frankly. And then the other, and maybe last way that a VC, especially early stage VC, they'll have a particular ownership target in mind. So they're going to invest a certain amount of money and say they want to actually have like a 20 to 25% ownership in the company, because that's the sort of math that they do for every sort of early stage investment that they're making. And so I think it's very valid to sort of talk about, before you get to kind of a hard number, understand actually how it is that a VC is even arriving at a valuation range, and where there may be some flexibility. And for every VC, it's not going to be a sort of hard number. It's not like, this investment is 12 million because I've ran it through my 5, Excel spreadsheets and spit out a number. It's more like it's a range, and you kind of want to understand how they've arrived at that.
Yeah, Kim, you talk about some sort of calculation going on in the background. I think from a CEO perspective, we also have that going in slightly different ways. The first thing I would say is, you really have to know who your venture capital partner is, right? Because if they are a VC that has the capability of starting with a Series A round or a seed round and then continuing as the company progresses, you're going to think about them a little bit differently. And that might be something you want to consider when you finally get down to talking about valuation trade-offs. The other thing to consider from a startup perspective is quite a lot of startups come out of academia. And there's always that kind of thing that everyone always forgets about, that you owe some university somewhere. So don't forget that, because they typically have some non-dilutive clauses in your licenses that protects them, that does not protect the company or the investors moving forward a little bit in time. So those are a few things to just be aware of when it comes to valuation. Obviously, you can think about and understand. You should really understand a lot about your own subsector in your life science industry. You know, what are other companies like mine doing? You know, where do we stand compared to them? So there is some. You know, you're not just flying in blind in a discussion. You should always frame it as to, you know, why you are deserving of such a range. So those are just some things I would think about going into you know, negotiations of a term sheet at the beginning. One thing, I'll add one more thing. Typically, the term sheet in a seed round or a Series A round may not be the first monies that actually come into a company. So there are a lot of groups that will kind of sidestep discussions about valuations by putting in convertible notes. So it's important to also remember that there are now, you know, de facto stakeholders that you also have to consider in that negotiation process.
And just a follow-up on the university licenses. In your experience, does it matter if you have the full license or an option prior to your first round of financing? Does it matter from a valuation standpoint, from a VC standpoint, or can you get an option and then close on the license kind of after, if they're making that kind of decision? And does that impact kind of term sheet discussions?
In general, I don't think anyone really likes the unknowns, right? So if you are so inclined to say, I'm going to spend the rest, you know, the next 7, 8 years working on a project, I would always suggest that people just go and license that product for, you know, global rights. I don't think I don't think it's often very expensive to do that. I don't think it makes a lot of sense to break it up. And I don't know how, Kim, you feel about this, but you know, if you're meeting someone and you know there are a number of questions that are unresolved, things that are you expect them to have already. I mean, from my perspective, it's just a really easy way to say, I'm sorry, you're just not there yet for me.
And so I completely agree, but I think for us it wouldn't really impact even the valuation, but it would be more to us like, okay, so this is more of a concept or an idea, and you have, you know, the IP potentially that's ready that you think needs to be in license, and we would say, okay, this is really sort of, it would go into our bucket of like, we're helping to now form the company, and we would say initially maybe we want to then put in, you know, 500,000 or so, and help actually, what's the sort of, you know, activities that we need to focus on in the first 6 months to be able to actually really say, okay, there's a company here now, and part of that would be actually going out and getting the license. And so for us, it would just be as, you know, a difference in terms of, do we think this is sort of a seed stage company where there's more sort of company formation efforts is needed, versus you've already got all the formation of the company and we're coming in as maybe the lead investor in the first round. And we're happy actually, you know, and I think there's a whole host of VCs that are happy to participate in that sort of company formation building process, but typically would say, okay, we're also going to now roll up our sleeves and sort of take more ownership as well, because we're helping to build that effort. And I think one of the unknowns that, like Rima says, there's some universities that are a little bit better about the whole, license, the IP. There's some that are a little bit more problematic to work through, and not actually for us. We go into it with that, knowing that, but it is also sort of, still something that has to be box checked, if you will, before we're really willing to put more capital at work.
Now, and so I think this also goes back to one of the points you both made earlier, which is there's a lot you can do to button up this process before you start fundraising. There are things, there's homework you can do beforehand. So, kind of questions for you too, are best practices in the fundraising process. When should they start doing this, right? So when is that, you don't want to wait till you're perfect, but when is it, when are you ready to say we're ready to go raise funds, but not be too early that, people say no, and then you have to go back to them again and get a second bite of the apple, right? So what are some of the best practices and timing for fundraising? And from your perspective, when have you seen things not work? Like what are, I don't want to say worst practices, but what are things that the company should generally avoid doing?
Can I start?
I'm happy. Oh, yeah. Go ahead, Raymond.
No,
Chime in.
It's easier to, I think, answer the latter part of that question. I will tell you, I'm not a big fan of constantly bombarding VCs with, okay, we're back to talk to you again. I think often they're very incremental changes, and I don't necessarily think that helps your cause in getting an investor to sign on. And I see this as well, and part of it is that I did have a little bit of a background as an investor for a period of time, so I get a lot of people who just constantly email me things, right? And I've met these people, I know them, but they keep emailing me updates, and it's clear they're emailing this to everyone. And I think that's not a very good way of building a relationship, because I think what you want is a fundamental relationship for business, not just a transaction. So a lot of people think of it in that way. So I would say, despite the fact that we're now in a digital age, I highly, highly recommend that you do go meet people, whether it's at industry events and then follow-ups and meetings. I personally think that goes a long, long way.
I think for me, it comes also back down to some fundamentals. I mean, at the end of the day, you're telling a story. So I think it's really the time to go out is when you feel like you have actually a good handle on what the need is that you're looking to fill, or what's the problem that you're looking to solve, and then the elements to how you're actually going to solve that. But you have to be able to engage in a way and tell that story in a compelling manner. And so my advice actually is to figure out who are the most likely VCs or groups that are actually going to be the ones you want to target, and don't go target them first. Do some practice pitches. Go to Rima. Go, there's a whole host of folks that connect that know what good stories should look like. There's a bunch of great entrepreneur founders, serial founders that are in this San Diego area that people can connect you with and practice, the ones that I respond to often when I know it's too early for what we're looking for, but I'm happy to meet an entrepreneur for a coffee and hear their pitch and say, hey, this is what resonated, this is what didn't resonate. And there have been times that I've actually had that initial meeting with an entrepreneur and actually got compelled enough to be able to help them, make some introductions for them, And lo and behold, actually sort of even downstream ended up investing in the company, but not, initially the engagement is really because all of us actually want to be, helpful to the San Diego ecosystem and help great entrepreneurs. And so there's a lot of people that are willing to be the first point of call and listen to the pitch. And so I would sort of take advantage of that and save, as soon as you feel like you've really honed that, then go and talk to the VCs that you think are the perfect quote unquote match for what you're actually looking to build.
Yeah. This is going to take time. So you have to set your expectations appropriately. You're going to have, as a CEO, really thick skin by the time you get through this process, because you will hear no far more than you will hear yes or even maybe. But it should be a learning experience. Some of the friends that I've made in the venture world now are great advisors, and they have not written a check to me. And that's just it happens, and I recently called one and, tongue in cheek said, why do you hate me so much? Laughed about it, but
it wasn't me, for full disclosure. No,
no, it wasn't Kim, but you can you shouldn't necessarily, from an entrepreneurial side, take this to heart, in a sense, right? Your value and your technology and your company is not based on a seed round of investment or a Series A, right? So you have to persevere, you have to push forward, you have to figure out ways in which you can make this work with or without capital. And there's always something you can do, from my perspective.
No, and so I think I'm going to follow the string of this takes time, and saying, how does that evolve with kind of the market conditions today, right? So, I mean, we've seen what's happened in biotech the last 2 years and now the last 6 months. It's an evolving condition, like market conditions. So how has that, affected fundraising? Has it become more investor friendly? Or is, how are we pivoting or changing? And so what should our companies keep in mind? It takes time, but does that advice change with the market conditions evolving?
It absolutely does. And I think, it hasn't, I wouldn't say it's become more investor friendly, because if anything, what the investors right now are actually doing is looking at their own portfolio and saying, okay, we have, X amount of money in our portfolio or in our fund as a whole, and what do we need to actually do to ensure that the existing companies are going to actually have enough capital to survive. And so, the reality is, while there is a lot of, in theory, dry powder sitting around on the side, it's mostly allocated right now for existing investments. And that means actually that it's not to say that new companies aren't getting created and aren't getting invested. It's just, it takes, like to your point, Deepa, it's taking a lot longer than it has. It used to be that you could actually sort of envision maybe 3 to 6 months. Now I would say it's more like, 9 months or so, 9 months, almost a year, to actually sort of get through the process. Again, it depends on what stage the company's in, et cetera. But with that said, and at Domain, we've had the benefit of having been through a lot of different cycles, and that's just it, right? There's going to be good fundraising periods and bad fundraising periods. I feel like we're actually coming out of one that has actually, because we essentially got out way over our skis, just after the pandemic, and money was flowing, and valuations were really sky high, and things got a little bit silly. We've now actually hit this trough where it's going to take a while to work through, but it feels like there are already some signs that there's, certainly it starts with the public markets and then flows through to the privates. And it feels like there is at least some signs of hope that the money's starting to flow again. And, good companies with fundamentally, an ability to be able to make a change in healthcare still end up actually getting, getting funded. So, hopefully that's not too depressing a view on things, but it does certainly take a lot longer than it used to.
Yeah, I think timing is it's very important in just being an adult, right? We all know this. From a entrepreneurial side, from a CEO perspective, it's kind of my philosophy that that's something you can't control, but there are certainly other things you can. So focus in on those things. So at Cytonus, we did not have good timing at all. We started the company January 2020, and by March of 2020, we were pretty much done. No real prospects of raising money for a novel platform. So my co-founder and I sat down and we just started figuring out how we're going to be better off as a company at the end of the pandemic. And for us, it was writing non-dilutive grants, and we went on a 2.5-year tear where we got 8 grants in a period of that time. And every grant we got, it directly correlated with a round of monies that came in. So there's always something you can do. And now we kind of take that theme forward with doing strategic deals as well. So if your technology is good and you have the ability to find ways, clever ways to get things done, that's the most important thing. I think your investors will be very appreciative of that as well, because at the end, you have to move your data forward and you just got to get a little bit closer to the end goal.
Perfect, thank you. It looks like we're coming to the end of time. So, and I just wanted to see if there were any questions that we haven't answered yet. Happy to do that. And I'm speaking for Remo and Kim. They're happy to do that. So, so I just wanted to see. I think there are 2 questions, but it seems like we may have answered them. One was, it's an early stage biotech. How should we approach the investors' questions about our valuation? I think we discussed. Second was, how long and how much touch points are typically required for a startup to get funded? How much time should a founder budget for their runway to get a term sheet? We said it's taking longer, but as far as how many touch points are required, I think Remo, you said don't hit them all the time. Yeah, right. So it's
have some sort of milestone or a reason to talk to people, right? We just got a paper published, or we just signed an important contract, or our first customer, whatever it may be. There should be some reason to kind of demonstrate to the venture capitalists that you're executing your plan, the plan that you shared with them, months earlier.
Well, and I think another piece of that, actually, when you're saying sort of touch points for a startup to get funded, so is that, if as you're actually, I think it's perfectly legitimate as you actually have your first, second meetings with a particular VC group to ask actually what's their process, so you can better understand what you're working towards with that particular VC group. And 2 things that I actually, would also comment on here, if they're asking actually about your valuation, I think they're trying to get a sense when they ask that question of not only, okay, what is your post money, but, really, how does your existing investor base, existing board actually think about valuation? And the best way to answer that is this is our post money, and we're actually, we understand market conditions, and we're actually looking to understand, kind of where you think the valuation of the company is, given that we've actually achieved X, Y, Z, right? And so you're really not saying, oh, our post money is, 25 million and we're expecting a 50% step up, right? Because you don't really want to go into the discussion sort of with that type of answer. But I think fair to actually say, this is our post, and we understand the current market conditions, and are actually, looking forward to hearing your thoughts as you complete your diligence. That would be the way that I would answer it. And I've certainly, just for reference, like when I was the founding CEO of Truvian, and we ended up actually, because of the Theranos debacle, having to keep going on the seed. To Rainbow's point, our seed was supposed to last 6 months. I stayed on as the CEO for 2 years. And the reality is, myself and Dina Marinucci, my co-founder, we probably actually did about 70 different VC calls VC meetings in order to actually get the company's Series A done. It can be brutal, but but at the end of the day, you'll hear a lot of no's. But it is actually, I think, a matter of kind of listening to what you're hearing, refining, maybe not going back to the same VC, but to be able to actually kind of continue to incorporate the feedback you're actually hearing, and refining your pitch.
Now, I just want to add one thing, because I think, Kim, you said this a few times today, that the storytelling is super important, and you actually have to refine your pitch often, more than we like to do, because it's kind of hard work. But the company is growing; it's a living thing. Your deck has to be a living thing, and you have to show a certain level of flexibility, because you are going to meet some milestones and you're not going to meet others, and you really need to articulate that very nicely to investors.
Thank you both very much. This has actually been a really fun panel, and I think really candid and open answers to this group. So I think I think we're at time. Thank you all for attending, and Petra, I think I will turn it back over to you.
Great. Thank you so much, Deepa, for moderating today's session. It was totally insightful. And thank you, Kim and Remo, for joining. All of you provided some great insights and much relevant advice for startups in the life science sector. Thank you, everyone who joined us today. Again, apologies for the technical glitch there, and thank you for your patience. I hope you found today's webinar insightful for the companies you're building. This webinar is recorded and will be sent out to everyone who registered. And we hope that you will be joining us for future sessions about capital insights. Wishing all of you a great day. Thank you so much. Bye-bye.
Thank you.